Good morning everyone, good afternoon, good evening, whenever you are watching my video, and Merry Christmas and Happy New Year to you. Recently, one of my viewers requested that I take a look at Booktopia. Booktopia is an online book retailer in Australia, and recently they were listed on the Australian Stock Exchange with the ticker code being BKG. The IPO price was $2.30. And when I made this video, which is on the 16th of December, the price of the shares was $2.80. So it's actually gone up 20%, which is quite rare in an IPO because a lot of the times when a company goes into IPO, the price of the shares actually drop after the IPO. It's been over 2 weeks since Booktopia was listed and the price still hasn't dropped yet. So is Booktopia a buy? In this video today, I will be telling you that I'm not personally buying Booktopia right now. I think Booktopia might be a great company and might be a great investment, but I'm not convinced and I do not know enough about the company. This is why. So to begin with, I have a bit of a bias. So I do not like to buy IPO because a lot of the times when a company goes into IPO, it's done because the company owners believe that they are able to get a very high price for themselves. So a lot of the times when you buy into an IPO, you are essentially getting ripped off. Because if the company is a great company and the founder actually has money, the founders wouldn't be selling the business to other people, right? They want to keep the business to themselves and for themselves. Now, if the founders do not have money, they normally get money from the bank if the bank thinks that the business actually makes money. So if a bank gives them a loan, it's almost like a proof beyond reasonable doubt that the business is going to be successful. If the bank doesn't want to give them a loan, then it's still possible for the business to be successful, but it's not beyond reasonable doubt. So with Booktopia, I looked at their capital structure, and at the moment, before the IPO, they had a couple of loans. So one is from a company called Longreach Credit Investors. So this company seems to be like a finance company. On their website, it is an Australian private debt investment management firm specializing in bespoke financing to Australian lower middle market companies while delivering attractive risk-adjusted returns to investors. This one's okay, but the next debt that they have is redeemable preference shares to Booktopia Management Pty Limited as the trustee for Booktopia Investment Trust number 1 with a fixed coupon rate of 12% per annum. By the way, I only spent about an hour researching into this company, so I have probably missed something, and I'll be glad if you can point this out to me. I think this Booktopia Investment Trust might be a trust that's controlled by one of the founders of Booktopia. It's interesting how this trust receives a fixed coupon rate of 12% per annum, which is very high. So to me, it feels as if the person controlling this trust, which is probably one of the founders, is shifting money away from Booktopia to himself. And I don't have a good feeling about this kind of arrangement. Let's look at what the company says they will do with the money that they receive from the IPO. So if I look at the IPO prospectus, it looks like they wanted to raise $43 million. $7 million will be to invest and expand the distribution center. And then another $7 million will be for working capital. There were some interviews where the CEO said it will be for increasing the automation when processing and fulfilling the orders. Around $3 million will be used to repay debt, and $8 million will be used for the offer costs, and then $18 million will be used to pay shareholders.
From my understanding, the CEO is staying, but his brother and his brother-in-law are leaving.
It's likely that the shareholder leaving the company is the one that currently has that preference shares that is getting the 12% per annum return. I will probably need to look more into it to find out who is actually controlling that investment trust that I mentioned to you before. But for this unique and unusual circumstance, I think Booktopia itself as a business is probably okay because I believe that the book market is here to stay in Australia. So the book market in Australia is a $2.5 billion market, and at the moment in 2020, the sales turnover of Booktopia is only $165 million. So that's only around 6.5% of the overall market for books in Australia. So Booktopia has a lot of room to grow, that's for sure. Sure, there are some people that think that the hard copy book market is going to go away. I personally don't think that's the case. So Booktopia sells the majority of their books in hard copy, and they say that ebooks are actually on the way down. So it's the hard copy that's on the way up, the ebooks are on the way down. I actually believe this to be true because for me personally, even though I don't read a lot of books, when I do read books, I like my book to be in hard copy. Because if you look at my glasses here, I have a very thick, don't know if you can see, I have a very thick subscription. So generally speaking, reading books on the computer or on the mobile phone is not good. We already spend a lot of hours on our mobile phone, so the last thing we want to do is to spend even more time on our mobile phones. Research also shows that if you read a book physically, you tend to remember what you read a bit better compared to if you read the book on the screen. So I do think that the book market, the hard copy book market, is here to stay for Booktopia. There will be some competitors. Apparently now Amazon Prime can get you a book delivered in 2 days, but Amazon doesn't focus on only books. So book is only a small percentage of their business, so they probably wouldn't have as big of a range as Booktopia. Booktopia has both the story books like novels, and also they have a lot of academic books. According to them, academic books have a higher gross profit margin, and they have been actually focusing more and more towards academic books. The average order value of Booktopia in 2020 financial year was $65. So with this kind of order size, the shipping cost is probably something like $10 or $20. So I think the margins should be there, and I do believe that Booktopia could potentially grow. I'm just not comfortable enough with the fact that they issued shares just to pay down debt and to pay down the existing shareholders who want to sell. And these existing shareholders, I will need to do more research, but I think these shareholders are the shareholders who were getting the 12% interest from their preference shares. Their preference shares got converted into ordinary shares upon IPO, and as a result they are selling their shares. So that's my interpretation of what's going on, which by the way could be wrong. The second thing I do not quite like about Booktopia is that they had very little cash before the IPO. They actually had more liabilities compared to assets, more current liabilities compared to current assets, and in fact they had a negative shareholder equity. So if they weren't able to maintain healthy cash flow before, then I want to see a few years of track record of them being able to do so before I invest my own money into the company. And the third concern I have is that Booktopia, I think, has done pretty well in 2020 because a lot of people were staying at home and they had free money from the government, the JobKeeper, JobSeeker, the superannuation early access, mortgage deferrals. So a lot of Australian households have a lot of extra money in their bank accounts. So with the extra money and the extra time, they buy books. So books are discretionary spending. So with discretionary item, it means that it's an item that's not essential in your life. So if you look at groceries, it's essential because you need to eat. But something like a book, you don't have to read a book, right? So if you don't have money, you normally do not buy books. So next year, when there is no more job keeper, job seeker, and no more mortgage deferral, and your money has run out, you will stop buying books. Even though this year the growth of Booktopia has been impressive, next year we do not know yet whether it will be the same. So I want to see a few years of consistent growth from here on out before I invest my money into Booktopia. Let me know what you think, guys. Did you enjoy this video and would you invest into Booktopia? Please do comment in the section down below, and don't forget to like this video and share this with one friend. Thank you again. I hope you have a good day and enjoy your holiday.